Fed officials see action from them if growth doesn't pick up soon. That's economic growth. It's just in. This is breaking news now. Federal Reserve says it's moving closer to action to spur growth, and that could include bond buying, more bond buying, rate guidance, i.e. interest rates could be lower, and lower reserve rates are all among the Fed options. That decision could come as soon as next week or in September. We have the man who reported this, Jon Hilsenrath, joining us now from Washington, D.C. Jon, thank you very much. This paper is so hot, it's just the ink's not even dry. Tell us what you learned and give us some of the nuances here.
Well, I think the market's been learning this for several weeks now. The chairman gave testimony last week where he talked about his disappointment with growth, and he laid out some of the options that the Fed is looking at. And I think that's what we're exploring in this story, that the status quo is unacceptable to the Fed. They want to see faster growth. They want to see unemployment coming down faster. And if they don't see it, then they're going to do more to address that.
So we all know what the bond buying is.
Hey, Simon, I want to say something to the people in our back office. I'm getting an echo in my earpiece. Okay. Maybe you could tell them to turn it down.
Maybe we could do that. I think you just did. Thank you very much, Jon. We'll try to deal with that. Tell us more. We know what bond buying is. That's the so-called QE, the printing money program. Yeah. What do you mean in your story by rate guidance, and what is a lower reserve rate do? Explain those two things.
All right. So QE is the thing that everyone's been kind of talking about for a while now. Rate guidance is they've been saying since since January that they don't expect to raise interest rates until late 2014 at the earliest. They do that to try to hold down longer-term interest rates. They could push that guidance out and say they don't expect to raise rates till even longer, until 2015. In fact, the markets, if you look at futures markets, they're not, futures markets indicate investors don't expect the Fed to do anything until 2015, and the Fed could decide to confirm that expectation by acknowledging it in their policy statement. They also have an interest rate, they're paying banks 1/4 percentage point for money that they leave on deposit with the Fed. Alan Blinder was in our paper yesterday arguing that the Fed should reduce that rate. Banks shouldn't be rewarded for not lending. And that's something that also could be considered. The chairman talked about some of these things in his testimony last week. It certainly is all considered. I think one of the most important issue here is that patience is just wearing thin there. That we're going to get a print on GDP later this week that's possibly less than 2%. The unemployment rate hasn't come down for much, if at all, since the beginning of the year. And they want to see more progress on the economy. They've been saying it for a while, and patience is wearing thin.
So let's go back to that last one you talked about, which is the lower reserve rate for the bank. So when a bank has money on deposit with the Federal Reserve, our central bank, it earns 1/4 percentage point, and it's basically getting rewarded for not lending that money because it's completely safe to have that money. Could they go negative and say, if you want money on deposit with us at the Central Bank of the U.S., we're going to charge you money to look after that for you because you really should be lending like you promised to do when we bailed you all out?
In theory, you could do that. Some central banks have tried that. The problem is that, there really isn't such a thing as a negative interest rate because, the alternative is to just hold cash. People could just, individuals could just put cash under their mattresses and, and not deposit it anywhere. And then that way they don't have to pay anyone to hold it for them. So, I'm not sure that would get them very far. The other thing, point I want to make...
Jon, that would be very hard for a big bank like a JP Morgan. That's a lot of notes to put somewhere.
Yeah, you need a lot of mattresses. But, my point is that it's technically very difficult to achieve. And I don't think we're anywhere near that point. And, it would do, who knows what kind of damage it would do to money markets and short-term lending markets. The other point I want to make is that, I realize the stock market tends to jump when they see stories about the Fed. The story that we write is what it says, that, they might decide at their meeting next week. There are many reasons why they might not even decide to make any decisions about this until September when they're updating their economic forecast. So, I don't want to give people the wrong impression that, that something is about to happen like right away It's certainly a very hot issue for the Fed, but as we lay out in this story, they might wait until September and look at the data before they make a judgment about whether growth really is picking up or not. So I think people should recognize that.
Jon, we just talked with Neil King, your colleague, about the election. New poll saying Romney's better equipped to deal with the economy than President Obama. How do you think this news from the Fed plays into that, or any potential plays into that election?
Well, Ben Bernanke was up on the Hill last week, and he had Democrats telling him to get to work, and he had Republicans telling him to be cautious. The fact of the matter is that no matter, he's damned if he does and he's damned if he doesn't. No matter what he does, there are going to be politicians who are upset with what he's doing. And he said he's going to do what he thinks is best for the economy. I think no matter what, they're going to be attacked on this front. So he really has no choice but to just make the best decision he thinks he can make.